Hey, it's Darius from CPAExamTutoring.com, home of the I-75 CPA review course. And if you're taking BEC very soon, check out some of my best bets for what's likely to be on your exam. And without a doubt, number one, IT. A question like this might be on your exam. Something very relevant that the CPA exam is likely to test you on is computer crimes. So check this out. A high school student created a fake website that looked identical to the school's website and then sent emails to teachers in an attempt to get them to sign in to her fake site. Right? So the girl who created this fake website is trying to get the teachers to log into the fake site. When a teacher signed in, this allowed this student to use the sign-in information to access the school's grading system, and the student began to change grades. What computer crime is being described? And you'd have to know your way around computer crimes to get this right. And the answer is phishing. Sure, this is a phishing exercise. With phishing, often an email will come in that seems to be from a legitimate trading partner like Intuit or LinkedIn, or it looks like it's from PayPal. And it will require you to immediately confirm personal information through a link. Or if you don't, it'll tell you that your account will be suspended. The problem is that the sender is phony and simply phishing for personal information. Delete the email immediately and do not click on this link. Those who engage in phishing often do so in a spamming mode. So the answer here would be phishing, letter B. Salami fraud, if you never heard of that, that's like penny shaving. That would be like a payroll processor taking away the last cent off everybody's net pay and putting it in their account and figuring you'll never catch it, because if you added up all the deductions from net to gross, you probably would think it was a rounding error if you were off by a penny. A logic bomb is a computer crime where the person who sets the logic bomb into the computer system sets it off to explode only if a significant event occurs. For example, if the disgruntled employee ever gets their name removed from the human resource system of the company, then the logic bomb goes off and there goes the computer system. So that's a computer crime as well. And password cracking, and that's just what it sounds like, where you sit there and try to figure out other people's passwords. So the answer to this would be phishing. And the CPA exam is likely to ask you a question on computer crimes because they are so pervasive today and they're so relevant. And if there's one thing the CPA exam insists on being known for, it's being relevant. So if there's something new and cutting edge and going on right in your face, they're going to ask you about it. So computer crimes, expect a question. In fact, I have a whole sim on computer crimes in the I-75 CPA BEC course. Let's try this question on computer crimes. Rather than attempt to gain unauthorized access to IT resources, some attackers threaten the system by preventing legitimate users from accessing the system by sending millions of requests. This is referred to as a denial of service attack, letter B. And in a denial of service attack, the hacker shuts down the system and can't even get into it himself, but basically holds it for ransom, usually demanding Bitcoin to allow it to be released. And you hear about this, cities and towns have been hit by this year, and that's why the exam will ask about it. One more IT question and we will move on. Which of the following best describes blockchain? A says digital currency that the IRS views as property. Well, that actually describes Bitcoin, because Bitcoin's digital currency and the IRS views Bitcoin as property instead of currency. B, solving mathematical puzzles requiring very fast computers. That also describes Bitcoin, not blockchain. So A and B are out. C, embedding technology into physical devices. That's what we call the Internet of Things. And that'll be tested on the exam, the Internet of Things, like a Fitbit, or technologies embedded into physical devices. So it's got to be D. Blockchain is new technology that enables continuous monitoring of the accounting system. Letter D is correct because that's what blockchain is. It is a new technology, and it does enable continuous monitoring of an accounting system. And really what's important about that is the future of auditing, because at the present time, auditors just sample for evidence. But if you're able to continuously monitor the accounting system, then you'll have an entire population of data just as easily as you can have a sample. All right, let's pivot to economics. Which of the following is correct regarding price and quantity demanded? All right, so you know about price and quantity demanded. If price moves first, quantity demanded moves in the opposite direction. So if price moves first and price goes up, what's going to happen to quantity demanded? It's going to fall off a little bit. So A says if price moves first, quantity demanded moves in the same direction as the price move. No, that's wrong. A is out. B says if price increases first, quantity demanded would be expected to increase as well. No, it will be the opposite. If price were to increase first, quantity demanded would be expected to drop. C says if price decreases first, quantity demanded would not be expected to increase. And that would be wrong, because if price decreased, quantity demanded would be expected to increase. So D must be right. If price increases first, quantity demanded would be expected to decrease. And that's true. An example would be if the New York Jets raised season ticket prices, that's price increasing first. Quantity demanded for tickets would be expected to decrease. If you were a season ticket holder with 4 seats and they raised the price on you, you might react by cutting back and only having 2 seats. And here's an illustration. Price, you can see, is moving from P1 down to P2. So as price drops, what happens to quantity demanded? It increases from X1 out to X2. So here price is moving first and it's going down from P1 to P2, and quantity demanded responds by increasing from X1 to X2. All right, what about cost accounting? Farrington Corp is a manufacturing company with both fixed and variable costs. Which of the following costs would decrease if production levels were increased within the relevant range? So this is a perfect example of what they could ask in cost accounting. Half the country would miss this. So they have both fixed and variable costs. Which of the following costs would decrease if production levels were increased? And the answers are total variable cost. Well, total variable cost would increase if production levels increase. Let's remember what we know about cost behaviors. Variable costs vary in total with production. So if production goes up, total variable cost would increase, but variable cost per unit would stay the same. For example, if a car manufacturer like Tesla spent $500 for each steering wheel, whether they made 1 car or 10 cars or 100 cars, steering wheels would still cost $500 per unit. That's a variable cost. That's a material cost. But the total variable cost would increase the more cars they made, because variable costs vary in total with production, but they remain fixed on a per unit basis. So which of the following costs would decrease if production levels were increased? It wouldn't be total variable cost, because that would increase if production levels were increased. And it wouldn't be variable cost per unit either, because they would stay the same even if production levels were increased. So A and B are out. Total fixed costs, well, fixed costs are fixed in total. So total fixed costs would not decrease if production levels were increased. Total fixed costs wouldn't change. And then what about D, fixed cost per unit? Yeah, here would be your answer. Because if production levels were increased, then while your total fixed cost would remain the same, your fixed cost per unit would decrease. And that's because if your rent was fixed at $1,000 a month and you made 10 units that month, then your fixed cost per unit would be 100 per unit because you only made 10 units that month and your total fixed cost was 1,000. And if you made 10 units that month, your rent per unit would be $100 per unit. But if you ramped up production and suddenly made 20 units that month, then your rent per unit would drop to $50 per unit. So notice that fixed costs, while they're fixed in total, they do decrease on a per unit basis if production levels increase. So fixed costs are fixed in total, but they vary on a per unit basis. On a per unit basis, fixed costs are variable. Now, what does this relevant range thing mean? Well, relevant range means as far as the eye can see. So we said that if Tesla needed steering wheels for their cars and they paid $500 per steering wheel, that would be over a relevant range. They would pay $500 per steering wheel. That means if they needed 100 steering wheels, 1,000, a couple thousand, whatever their relevant range is. But if they went outside that relevant range and produced a couple of 100,000 cars, maybe their steering wheel price would be different than 500. So within a relevant range, variable costs per unit would stay the same within a relevant range. But if you go outside that relevant range, anything could change. They might actually have to pay more than 500, or maybe they'll buy so many that they might even get a discount. But within the relevant range, variable cost per unit will remain the same. Fixed costs also, the relevant range comes into play because fixed costs are only fixed within the relevant range. So if you're paying $1,000 per month rent, that's only until your lease expires. So your total fixed cost is only fixed until that lease expires. Your relevant range is however long the lease is. If it's a 5-year lease, then your relevant range is 5 years. Once you get outside the relevant range, you're going to have a new lease. And what's the cost going to be? You don't know. It's certainly not fixed anymore once you get outside the relevant range. Speaking of fixed and variable costs, what about break-even analysis? Here's a question that asks how many units must be sold to break even. And if you remember the break-even formula, it's fixed costs divided by contribution margin per unit. So if a company's fixed costs are given at 140,000 and variable costs are 30% of sales and the unit sales price is $120, can we figure out how many units must be sold to break even? Well, we know the formula is going to help us by taking the fixed cost of 140,000 and divide by contribution margin per unit. And that's not given. The contribution margin per unit is not given. But the unit sale price is given at $120 and the variable cost percentage is given at 30%. So if variable cost is 30% of sales, then contribution margin must be the sale price of 120 minus the 30% for the variable cost. Because isn't sales minus variable cost equal to contribution margin? So that means contribution margin must be 70% of 120. And 70% of 120 is $84. $84 is your contribution margin per unit. So now we know we can divide our fixed cost of 140,000 by the contribution margin per unit of $84, and our break even in units is 1,667, which is answer choice A. So once we sell 1,667 units, then we broke even. And what does it mean to break even? It means you've covered your fixed cost. That's really what break even means. It doesn't mean you covered all your costs. It just means you covered your fixed cost. Because you can never cover all your costs, because every time you produce another unit, you got more variable cost, because variable cost varies in total with production. So if you produce another unit, you got more variable cost. But if you break even, it means at least you covered your fixed cost. It doesn't mean that you broke even, you covered all your cost. It means you covered your fixed cost. All right, remember to look over financial management too. This says how much should Fairbanks pay for Knox Corp shares today? If Knox Corp pays a current dividend of 2.5 per share, $2.50 a share, and Knox Corp is expected to grow at a 4% per year rate, and Fairbanks wants to invest in Knox and earn a 10% return, how much should Fairbanks pay for Knox Corp shares today? So how much you would pay for an investment today is a factor of the next dividend, not today's dividend, but the forecasted dividend. We'll start with the current dividend of 250, but we want next dividend, so we got to multiply by the growth rate of 4%. So take the current dividend of 250, multiply it by 1.04, and the next dividend is $2.60. So $2.60 is the numerator. Now the denominator involves required return, which is 10%, minus the growth rate of 4%. The denominator is then 6%. So now to determine how much we're going to pay for this stock today, we're going to take the next dividend, which is $2.60, and divide by 6%. And the value of the stock to us today is $43.33, which is letter D. Remember, when you get a question on how much to pay for a stock today, the numerator is the dividend, but not the current dividend, the forecasted dividend. And how do you forecast the dividend? You take the current dividend and multiply times 1 plus the growth rate. And that's what we did here. We took the current dividend of 250 and we wanted to forecast the next dividend. We multiplied 250 by 1.04. Another thing the AICPA likes to ask about with regard to stocks is the PE ratio. How do you calculate the PE ratio? Price to earnings. If a stock currently sells for $22 per share and has a growth rate of 4%, what's the forward PE ratio if the current earnings per share are $1.50? What does the term forward PE ratio mean? It means that the E in PE, the earnings, are next period's earnings rather than the period that ended. Rather than the period that just ended, we're interested in next period's earnings. That's the denominator. Forward PE means next period earnings divided into price. So price is the numerator divided by next period's earnings, and that'll give you the PE ratio. Now, they told us that the current earnings per share are $1.50, but we want the forecasted or the forward PE ratio. So that means we got to take the current earnings of $1.50 and forecast a 4% growth rate. So $1.50 times 1.04 will give us the forecasted earnings, the forward earnings. And that's going to be $1.56 over the next 12 months. That $1.56 is going to be your denominator in the PE ratio. And you'll take the price, today's price of 22, divided by next period's earnings, expected earnings of $1.56, and the PE ratio is 14.1. And this means that the stock today is selling for 14 times expected earnings. It's considered the forward PE ratio because the denominator is expected earnings rather than current earnings. And this means that the stock is selling for 14 times expected earnings. Is that good? Is that a good thing if the stock sells for 14 times expected earnings? Well, you can't really say in isolation. You'd have to compare that to maybe its historic PE. Maybe the stock historically has a PE of 20 or 19, and now it's selling for 14 times expected earnings. Then this would be a good opportunity to buy, because you want to buy a stock with a low PE, not a stock with a high PE. Low PE is better. You want a high E, but a low PE. Remember, price is in the numerator. Earnings is in the denominator. Whenever the denominator goes up, the ratio goes down. So you want to have a lot of E, a lot of earnings, relative to price, and that would give you a low PE ratio. And that's what you want. So if this was, let's say, Home Depot, and they have a 14.1 PE ratio, that means Home Depot is selling for 14 times earnings. You would then maybe compare it to Lowe's. And Lowe's might have a 22 PE. And which one would be the better investment? Home Depot would, because it has a lower PE ratio. And then, of course, overhead variances. Oh, yeah. How much is the variable overhead rate variance? So they tell us Bennett Manufacturing applies overhead based on direct labor hours. And each unit produced should take 1 hour of direct labor. In the month of March, 3,900 direct labor hours were used to produce 3,800 units with a standard overhead rate of $1.50 per direct labor hour. The actual overhead rate for March turned out to be $1.60 per hour. So it looks like they spent more on direct labor than they expected. $1.60, the actual overhead rate, $1.60 per hour. The standard overhead rate, $1.50 per direct labor hour. How much is the variable overhead rate variance? So we have 10 cents more than we expected. That's unfavorable. And what would we multiply that by? Well, since this is a price variance or a rate variance, you would always multiply by the actual direct labor hours, which are 3,900 hours. And you would take the 3,900 direct labor hours, multiply by the 10-cent difference, and you'd have 390 of unfavorable overhead rate variance. And the answer would be C. The variable overhead rate variance tells management whether more or less was spent on variable overhead than budgeted, based on the cost driver, which is direct labor hours. 3,900 actual direct labor hours times that 10 cent more being spent on variable overhead than budgeted, that's $390 unfavorable variable overhead rate variance, which is letter C. This is Darius Clark from I-75 CPA Review, wishing you best of luck with BEC.